Okay, so what I'm going to show you is what are the effects on DME companies as a result of Medicare's round 2 competitive bidding and the new reimbursement rates or the new single payment amounts. So what I've done here is I put together a little spreadsheet that can illustrate that, and it's a basic income statement. We're going to look at what does the income statement look like before competitive bidding. What does that same income statement look like now after these reimbursement rates go into effect? And then, most importantly, what we want to get out of this is what do we need to do in order to get back to the net income we were making before this round 2 single payer amount was implemented. Okay, so we're going to start with the before competitive bidding, and we're going to break this up into the different parts of an income statement. So the first part's going to be revenue, and the revenue is just the total amount of money that we made in the year from providing this product. So that's the gross amount. Then we have our cost of goods sold, which is the cost of the equipment that we put out on patients to generate that revenue. So revenue minus cost of goods sold gives us our gross profit. And gross profit is just the difference between the two. And we usually think of that in terms of gross margin, or the percentage of the amount we get to keep divided by the revenue. Then we have operating expense, and operating expense is all the other stuff that goes into running a business. So that's like your facilities, the vehicles, salaries, benefits, any of that stuff all goes under operating expense. So we take whatever gross profit we have, subtract out our operating expense, and that gives us our net income. The net income is the net amount after all is said and done that we actually got to keep, and hopefully that's a positive number. That's good for a business. So let's start here. Before competitive bidding, we're going to take a typical company. Let's say it's $500,000 in annual revenue. Okay. Now in this industry, typically our cost of goods runs at about 25 to 35% of revenue. So let's just take, for example, 30% of cost of goods. Well, if our cost of goods is 30% on a $500,000 company, that means our cost of goods is $150,000. So then we just take 500,000 minus 150, and we get $350,000, or 70% gross margin. Okay. Now what we want to do is look at what is our total operating expense. What's the total amount of all the other stuff that we use to operate the business? And typically this is in terms of the percent of operating expense as it relates to revenue. But a lot of people don't know what that amount is. So another way of finding out that amount is take a look at what your net income is as a percent of sales, and then subtract that from your gross margin of 70%. So let's just say that this company netted 10% of sales. Well, then 70% minus 10% would equal 60%. So we put 60 right there. So that would be a typical financial. So we would say our revenue is $500,000, our gross profit is $350,000, the amount of other operating expense is $300,000, and at the end of the day, we netted $50,000. Okay. So now what we want to know is how many patients did it take in order to generate this $500,000? So let's just say that we had 3,000 patients. Okay. So if we had 3,000 patients to generate that $500,000, that means that our revenue per patient is about $166 per patient. Okay, so that's all before this whole cuts and reimbursement. So as many of you heard, on Wednesday, January 30th, CMS announced the single payer amounts for the 8 categories plus national mail order for diabetic supplies. And on average, we saw about a 50% reduction in reimbursement. So now what we're going to look at is, how does that 50% reimbursement affect our financials? Let's just take 50%, and here we go. So let's start with revenue. So our $500,000 in revenue just got cut in half. So now it's $250,000 in revenue. Now, that revenue that we earn, the cost of the equipment is exactly the same. So $150,000 is still $150,000 because we're putting out the same amount of equipment. We just make half as much. So the interesting thing to look at is that our cost of goods went from 30% to 60% just in the cuts and reimbursement. So $250,000 minus $150,000 leaves us with a gross profit of $100,000 or 40% gross margin. So look at our margin. Our margin went from 70% down to 40%. Now, again, our operating expense is what it is. I mean, the cost of our facilities and our salaries and our cars and everything, it's still $300,000. So our operating expense stays exactly the same. But now look, it's 120% of our revenue. What that means is that for every dollar of revenue that we earn, all of it, plus an additional 20 cents, goes to pay for our operation, and we still haven't paid for any of our cost of goods. So if we take $100,000 minus $300,000, well, that's negative $200,000. So what this means is that nothing changes. We go from making a positive $50,000 to a negative $200,000 just because we had a 50% reduction in our reimbursement amounts. That's not good. So how do we fix this? Well, there's two ways that we can fix our net income. We can either A, increase our revenue, or B, lower our costs. So I want to show you a few things. If we decide to go with B, cut our costs, we can cut costs in two ways. We can either reduce our cost of goods or reduce our operating expense. Something to notice here on our cost of goods. We can't cut enough of our cost of goods to become profitable. Even if we had the greatest vendor out there and he said, all right, we're going to give you every product for free. Now our cost of goods is zero. We're still negative $50,000. So going back to the vendors and trying to pound them into lowering their cost isn't going to do us a lot of good. That's not really where we should be focusing our attention. On the same side, if we go into operating expense and say, okay, we're going to have to cut our expenses, our operating expenses, in order to become profitable, we need to cut this by 66%. It's $200,000 off of $300,000 just to break even. That means you're going to cut 66% of your rent, 66% of your staff, 66% of your vehicles. There's no way you can operate a business cutting back by 66%. That's just too much. So even a combination of the two is still, it's not enough to get us back to where we need to be. So cutting expenses in this case is just not the way to go because there's no way of doing it. So we know that in order to make this thing work, we're going to have to focus on increasing revenue. Now, there's two ways we can increase revenue. One, we can increase our price per unit, or two, we can increase the number of units. Well, if you remember, we talked before about what was our revenue per patient. And the way we figured that out is we took our total revenue and divided it by our total number of patients. So in this case, our revenue per patient was $166.66. Well, after competitive bidding, our revenue per patient is cut in half. So, and there's nothing we can do about it. We can't raise the price because that is established by Medicare. So our new revenue per patient is going to go down to $83.33, and we can't touch it. So it means that if we want to increase our revenue, we have to increase our number of units. That's all we have available to us. So the question is, how many units do we need to increase by to get back to where we needed to be? So we're going to make an assumption on this side over here that everything remains the same, but we're just going to increase our number of units. So if you remember, our net income before the cuts was $50,000. So we want to know, how do I make $50,000 again? So we're going to move $50,000 over here to the net income line on this part of the spreadsheet. And then we're going to work our way backwards. So we want to make $50,000, and we know our operating expense hasn't changed a bit. It's still $300,000. So that means we have the same amount of drivers, same amount of intake people, same cars and building and everything else. So in order for that to be true, our gross profit is going to be $50,000 plus our operating expense, $300,000. So we need to make sure we make $350,000 in gross profit to support $300,000 in operating expenses to net $50,000. Now, if you also remember, after our competitive bidding, our gross margin changed from 70% to 40%. So if we need our gross profit to be $350,000, that's going to be a 40% margin. So to figure out how much revenue we have to generate in order to get $350,000 in gross profit, we're just going to take $350,000 and divide it by 40%. And that should come out to be $875,000. So if we know that our revenue is $875,000 and we have a gross margin of 40%, that will tell us that our cost of goods, which would be 60%, is $525,000. Okay, so that means that we're going to have to have our revenue at $875,000 in order to generate $50,000 in net income. So how many units is that? Well, we're going to take our total revenue, $875,000, and divide it by a number of our revenue per patient, in this case $83.33, and that'll tell us that we need 10,500 patients in order to generate the kind of revenue that we need in order to make $50,000. By the way, that's a 250% growth rate. That's a lot. So now again, we're assuming here that our operating expense stayed exactly the same. So I don't know about you, but you may need a few extra drivers and you may need a few extra people taking phone calls to support a 250% growth in business. So I think the question we need to ask ourselves is, what is our true operating expense going to be if we're able to increase the amount of patients by 250% or more? So it's not going to be dollar for dollar, because we're going to have more volume, and the more volume gives us better economies of scale. So maybe our total operating expense grows by $200,000. So let's just say $500,000. Okay. Well, again, if our operating expense grows to $500,000 because we've added in more infrastructure, and we still want to make $50,000, again, going backwards, it means that our revenue needs to be $1,375,000 in order to generate $50,000 in net income. And most importantly is that if we divide that number by our new revenue per patient of $83.33, it means we need 16,500 patients in order to generate that same $50,000 in net income. And that's a growth rate of about 450%. Okay, so the big task is, how do I take my business from 3,000 patients to 16,500 patients? That's the challenge that is in front of us, and that's what we're trying to address. And I think we have some really good answers as far as how we can get that done. Okay, so that's it as far as the effects of competitive bidding. Next, we're going to talk about how we grow a number of patients from 3,000 patients to 16,000 patients.